The most shocking economic crisis in the Middle East today isn't in a war zone halfway around the world. It's right in Iran, a country sitting on one of the largest oil reserves in the world, yet facing a collapse deeper than many predicted. To understand why Iran's oil crisis and economic meltdown are worse than Russia's recent strains, you have to strip away cliches and look at the data, lived experience, and structural breakdowns currently playing out on the ground. Iran's economy has entered its deepest contraction in modern history, driven by a squeeze on oil revenue, runaway inflation, currency collapse, and fiscal mismanagement. After years of renewed sanctions, especially following the U.S. withdrawal from the 2015 nuclear deal, Iran's oil exports, once the backbone of its public finances, have not recovered fully to pre-sanction levels. Although crude shipments have climbed somewhat from their post-2018 lows, they still fall far short of the volumes needed to stabilize revenue and foreign exchange. Iran sits on enormous reserves, tens of billions of barrels, but production and export capacity have deteriorated due to restricted access to technology, spare parts, and foreign investment. Without external capital, aging infrastructure cannot be modernized, and wells that once produced reliably have begun to falter. Other exporters, including neighbors like Saudi Arabia and Iraq, have maintained or expanded output, leaving Iran increasingly marginalized. Meanwhile, inflation in Iran has soared to levels rarely seen outside hyperinflation episodes in modern history. Official figures and credible estimates place annual inflation above 40%, with food and essential goods often rising 70% or more in short periods. The national currency, the Iranian Rial, has collapsed, trading at over 1.4 million rials to the US dollar on the open market, a shocking deterioration that has wiped out savings and real wages. Those figures alone tell part of the story, but they don't capture the social and political dimension of collapse. Massive protests erupted in late 2025, triggered by skyrocketing food prices, currency collapse, and a sense that ordinary people are being crushed while political elites remain insulated. In cities across Iran, including Tehran and the historic Grand Bazaar, merchants closed shops in protest, and clashes with security forces led to hundreds and, according to some sources, more than 2,500 deaths. The banking system itself has become an accelerant of crisis. The collapse of significant financial institutions, including Allende Bank, which was deeply tied to regime cronies, revealed systemic fragility. Decades of bad loans, corruption, and reliance on printing money to cover losses. Rather than stabilizing the system, these measures accelerated inflation and eroded public confidence. Economists warn that the downturn isn't a temporary slump, it's a structural contraction. Domestic GDP has shrunk, poverty rates have surged, and basic services like healthcare, imports of medicine, and food security are in jeopardy. Around 22 to 50% of Iranians now live below the poverty line, depending on the metrics used. Contrast this with Russia's economy, another major oil exporter, and the difference becomes clear. Russia, despite heavy sanctions related to its war in Ukraine, has maintained a diversified industrial base, agricultural exports, and continued energy flows to key markets. Its financial system funds its spending, and it remains able to issue debt domestically and internationally. Economists argue that Russia's economy, while stressed, is not collapsing and still has buffers like foreign currency reserves and diversified revenue streams. To understand why Iran's crisis has become this severe, you have to look at how sanctions and internal mismanagement reinforced each other rather than acting separately. Sanctions alone rarely destroy an economy. What they do is expose weaknesses. In Iran's case, those weaknesses were already deep. For decades, Iran structured its economy around oil rents and state control. When oil money flowed freely, inefficiencies could be hidden. Subsidies masked inflation. State-owned banks extended bad loans without consequence. Crony networks replaced productivity. Once sanctions restricted oil exports and access to global finance, that entire structure began to collapse inward. Oil revenue didn't just fall, it became unreliable. Iran was forced to sell crude at steep discounts, often through intermediaries, shadow fleets, and opaque arrangements that reduced net income even further. Payment delays, barter deals, and currency conversion losses meant that every barrel earned less real value. This made fiscal planning nearly impossible. Government budgets became exercises in optimism rather than reality. To fill the gap, the state turned inward. It borrowed from its own banking system and leaned heavily on money creation. This is where inflation accelerated from chronic to destructive. Printing money didn't stimulate growth, it compensated for missing dollars. Each new Rial diluted purchasing power, pushing prices higher and fueling a vicious cycle of currency depreciation and inflation expectations. Unlike Russia, Iran lacks deep, trusted domestic capital markets. Russia can issue debt internally, compel large energy firms to fund the state, and rely on a diversified export base, including agriculture, metals, and weapons. Iran cannot. Its private sector is constrained, capital flight is constant, and trust in institutions is low. When confidence disappears, even basic monetary tools stop working. The banking system illustrates this perfectly. Iranian banks became repositories for political lending, financing projects tied to elites rather than productive enterprises. As non-performing loans piled up, banks relied on central bank support to survive. Instead of restructuring, the system was propped up. Each bailout injected more liquidity into an already overheated economy, accelerating inflation and eroding public trust. This breakdown spills directly into daily life. Imports of medicine, food, and industrial inputs become erratic. Small businesses cannot plan. Wages lag far behind prices. Savings evaporate. People rush to convert cash into dollars, gold, or real assets, further weakening the currency. Inflation stops being an abstract number and becomes a behavioral force shaping every decision. Social stability erodes under these conditions. Protests over prices aren't just economic, they are signals that the social contract is breaking. When oil wealth no longer translates into basic security or opportunity, legitimacy weakens. The state responds with repression rather than reform, which deepens isolation and reinforces sanctions, completing the loop. This is why comparisons to Russia matter. Russia's post-sanctions economy is strained but functional. Iran's is stuck. It cannot fully integrate with global markets, cannot stabilize its currency, and cannot credibly reform without political transformation. Oil alone is no longer sufficient to anchor the system. Iran isn't bankrupt in the legal sense. It still operates, it still exports, but economically it is insolvent in real terms, unable to convert vast natural wealth into stability, growth, or confidence. And that is the most dangerous form of collapse, not sudden default, but slow institutional failure. Looking forward, the trajectory of Iran's economy depends on three forces: oil markets, external alliances, and internal governance. None of them currently point to recovery. Oil prices, though higher than the lows of 2020, cannot compensate for production bottlenecks caused by aging infrastructure, lack of foreign investment, and sanctions. Each additional barrel exported brings less net revenue than before. The economy's margin for maneuver is shrinking. External alliances offer only partial relief. Russia and China have historically provided Tehran with diplomatic cover and selective financial or energy deals, but their assistance is strategic, not altruistic. China's support, often framed as infrastructure investment or barter trade, ties Iran more closely to Beijing's global agenda and reduces Tehran's autonomy. Russia's support is limited and contingent on geopolitical alignment, not economic sustainability. Neither partner is positioned to stabilize Iran's currency, control inflation, or revive domestic production at the scale necessary to restore ordinary livelihoods. Internally, the government faces structural contradictions it cannot resolve. The very policies that enabled elites to capture oil wealth and maintain political dominance, subsidies, state control, and crony networks, now prevent the adoption of reforms that could stabilize the economy. Removing subsidies would immediately reduce public unrest, but exacerbate inflation and hunger. Tightening fiscal policy or reforming state banks would threaten entrenched power. The state cannot shrink and survive simultaneously. The result is a self-reinforcing collapse. Inflation continues to erode purchasing power, while currency depreciation incentivizes capital flight. Oil revenue struggles to meet even minimal budget requirements. Public discontent grows, protests persist, and trust in institutions erodes. Every measure the government takes to fix one problem worsens another. This is the essence of structural insolvency. The economy cannot generate enough real resources, not paper money, to function sustainably. Compared to Russia, Iran's situation is uniquely precarious because of its dependence on global trade restricted by sanctions and the fragility of its domestic institutions. Russia, by contrast, can still leverage diversified exports, alternative energy markets, and domestic credit to maintain functionality. Iran, despite vast oil reserves, cannot. The collapse is deeper and more socially corrosive. Citizens aren't simply seeing a slower GDP, they are experiencing everyday survival stress, rising food costs, medical shortages, and insecurity. Historically, crises of this depth are rarely reversed without radical intervention, either external relief, regime change, or a combination of both. Venezuela and Zimbabwe provide sobering precedents. Natural resource wealth does not guarantee economic stability if governance, sanctions, and market access fail simultaneously. Iran today mirrors those patterns, but with far greater scale, given the size of its population and economy. The irony is brutal. Iran sits atop one of the world's richest oil reserves, yet its citizens are poorer and more insecure than many less endowed nations. Oil, once the engine of state power, has become insufficient to preserve stability under the weight of sanctions, mismanagement, and financial isolation. In the end, Iran's crisis is a lesson in how resource wealth cannot substitute for structural resilience. Markets, governance, and public trust matter just as much, if not more, than reserves beneath the ground. For the world, watching Iran falter is a stark reminder. Energy alone does not protect an economy, and sanctions, coupled with weak institutions, can produce a collapse far worse than war or default.